Morning, good morning. I was listening to our MBS reporting today. Again, this is a guy I listen to quite a bit. He kind of helps me understand the market, what's going on. And since there was such a big improvement today in rates, I wanted to let you guys hear a little bit about what's going on in the market. So, real quick, if you're interested, take a listen.
Better inflation numbers, and we got it. But instead of getting the bulk of this benefit this morning, we got it a little early yesterday. It was an afternoon delight. In bonds kind of followed suit what we're anticipating, that it would be a little rocky if we get past Jerome Powell. We'll talk about his comments in a minute, but first, the inflation numbers. Now, mortgage bonds are flat this morning, but as we see on the chart, we're up like 80, 90, depending on when, 100 basis points. So a wonderful gain. 10-year treasury right on our target exactly. It's battling that level right now. I'll show you that. But we do have some big news tomorrow to contend with as well. It just keeps on coming. The inflation numbers today on the PCE, personal consumption expenditures, Fed's favorite measure, came in pretty good. Headline up 0.3, core rate up 0.2. Mild, certainly a lot milder than we've seen. Now, on a year-over-year basis, we did see those numbers come down as well. Core rate, which is very closely watched, is the number they want to get to 2%, or maybe they'll tolerate a little bit more. It's still well above it, but it is now at 5% from last month's revised number 5.2. That's a nice drop. And it's well off the highs that we had seen at 5.4. On the headline number, that's at 6% year over year, and that is well off the highs of 7%.
So basically, what he's saying, it's a lot easier to understand this stuff when you listen to it every day. But basically, what he's saying is that by raising the rates, inflation has started to cool off, and so we should see rates start to act accordingly.
So inflation is coming down. There's more evidence that we'll continue to see this come down, just like we've been explaining. That 10-year treasury, boy, oh boy, which was at 4.33%, is now down about 65, 70 basis points from that. It's a big move in less than a month, in about 3 weeks, when you consider from getting that good CPI report. Now, we think these numbers will continue gradually coming down. It's not going to be a straight line. We're feeling pretty good and optimistic that rates should be moving in a positive direction. Now, the Fed, of course, they're going to talk tough, but they've been talking tough. At the end yesterday, we got to hear from Fed Chair Jerome Powell, and it kind of ignited the beginning of this rally. But break that down a little for us.
Yeah, I thought Powell's comments were very interesting. Many in the media kind of saying that there was no news here, a non-event, but I would certainly disagree. Powell seemed to really clearly change his tone a bit. Maybe he's starting to see the light, but he said that he thinks it's time, maybe at the next meeting, really telegraphing this, to start reducing the size of the rate increases. So as other Fed members have been saying, we think 50 basis points December 14th. And, he's still trying to talk a little tough, saying the Fed funds rate may end up higher than they previously had stated. But he did acknowledge the fact that the cumulative impact of their rate increases has not been fully realized because of lag effect. So I thought this was a big tone shift, certainly less hawkish. And boy, the bond market interpreted it that way and rallied it. End of the day, up almost 80 basis points yesterday.
Dan, I wonder if he had a sneak peek at the inflation numbers. I just wonder if he had a sneak peek and that kind of changed his demeanor, right? Because he'd been talking pretty tough and seeing those inflation numbers, right? Do you think that's a possibility there? Maybe that's what caused it?
I think it's certainly, wouldn't be out of the question. And it could be one of the reasons why he shifted that tone.
And on the inflation front, something that would certainly help with lower inflation is lower rental prices. And we did get Apartment List national rent report for the month of November, and this declined by 1% month over month. And that's the largest decline since the survey started in 2017. And year over year, they're only going up now by 4.7% versus the higher levels that they were at earlier this year. Now, looking at this chart, you can see this pretty sharp deceleration at the beginning. And once this continues, it's going to be a great help to inflation because remember, as we've been telling you, 39% of core CPI is made up of shelter, which consists of rent, owner's equivalent rent, and lodging away from home.
And today we got initial jobless claims, which are down 16,000 to 225,000. Now, this was for last week, a holiday week, so the numbers could be distorted here. But as a reminder, even though this number is lower, that is still 225,000 new individuals filing for unemployment benefits. That's not people coming off of unemployment benefits. Speaking of coming off unemployment benefits, continuing claims, which are as of 2 weeks ago, so preceding that holiday week, rose 57,000 to 1.6 million. That's an increase of 262,000 in just the last 10 weeks to the highest level since February. As we've been mentioning, more and more people who are filing for unemployment benefits are staying on unemployment benefits, indicating that it's difficult for those workers to find new employment.
And more on jobs, we got the Challenger Job Cuts report for the month of November, showing that 77,000 jobs were cut in November. That's up from 34 in September, and it's the highest since January of 2021. Now, the tech sector is leading the way for losses. They have the highest amounts both on a monthly basis and on an annual basis since the survey began back in 2000. And if this wasn't enough with jobs, tomorrow we'll be getting the big BLS jobs report.
For sure, that's gonna be a big one. What a week, huh? Let's take a quick look at the charts and go over this stuff because we are flat on mortgage-backed securities now. But I mean, you take a look here, we got the gains. We got it in the afternoon delight yesterday. So between what we had seen, what initially prices had gotten worse to the rally that we'd seen, 105 basis points, 80 basis points, 95. So these are changes from yesterday, changes from Wednesday. So very, very.
My guess is that when we start talking about this, I can't tell what's the rolling 10-day average, maybe 100-day average. I can't tell what color that is, but basically this is a floor of resistance right here. If we can stay above that, this is our big gain from yesterday that will probably bounce here. But if we stay above this floor, we've got a ton of room to improve. And that's all good news.
Good reaction to the bond market, and you can see big up day. Now this morning, while we're flat, natural thing is after a big gain, you see some give back, but look where we stop, right at the 100-day moving average. So now this will help us and act as a support level now that we've broken above this level. And if we take a look at the 10-year treasury, on the 10-year treasury, you can see that we're in a very, very tight range. But look at this, another target hit, 357 this morning, 3.57 this morning. And we are now at 3.6%. Very tight range, as I mentioned. If we get past the jobs report favorably, we can see yields drop under 3.5 to a level about 3.4 with a 100-day moving averages. Amazing the drop that we have seen since that good inflation number came out. One word of caution on both. And on the 10-year yield, we are at a very oversold level in yield, and on mortgage bonds, a very overbought level in price. This makes us susceptible to a potential exaggerated swing if the jobs number tomorrow, as Megan mentioned, comes out as an unfriendly number. So we want to make sure we're very careful about that. Talk to you guys tomorrow. We're going to start today floating into the jobs report.
So I know it's long, but that's what I'm listening to basically every day to make sure that we are staying on top of the loans that we have in our system and we're locking them at the right time. I had a guy that has been on me pretty much every day about where the market's at. I've kept advising him to float. I think we started out at, this is a jumbo deal, I think we started out at like 6.375 and now he's down to 5.875. So I advised him today I would continue floating, but really what this means to me and what I imagine this is going to relate to is that if we can continue this, we should see rates getting into the sixes, the mid sixes, maybe as soon as December. And probably Q1, low sixes, maybe high fives, and Q2, hopefully we get that back down to that mid-level of fives, maybe even into the fours. So that's what we've kind of been projecting based off what we're hearing from Barry Habib and his crew. I know this is a long video, but if you're interested in getting this every day, just let me know. I can record it and send it out. Or if you just want kind of the Cliffs Notes version, you can always feel free to call me. Hope you guys are doing great. I know it's the holiday season. I think things are starting to slow down a little bit. Take time to remember what's important and spend time with your family and friends. And if there's a chance for us to get together, let us know. We'd love to take you out to lunch or dinner and catch up. So hope you guys are all doing great. Talk to you soon.